I am not a good investor. Most of the time I make loss in my investments. What is the correct way to invest? If these are some of the questions that you are looking to get answers of, you are at the correct place. No one is a perfect investor. Even Warren Buffett, who has a business for decades, makes a few mistakes of his own. If you want your portfolio to be the best it can be, then keep watching to understand what Warren Buffett thinks are the 12 mistakes every investor makes and how you can avoid them. Number 1. Following the crowd. If you want to be a successful investor, you need to know that your portfolio should not just be based on what everyone else is doing. Mr. Buffett also said that he and his business partner, Charlie Munger, are better investors than other people because they do not care what other people do. In the world of investing, there are a lot of different points of view, schools of thought, and ideas that do not make sense. When everyone is trying to follow the same trend, it is likely that they are all wrong. Using the sheep as an example, you can see that going along with the crowd probably will not get you anywhere quickly. If one sheep jumps off a cliff, it is likely that more sheep will do the same. Number 2. Getting too attached to your purchasing price. Buffett says that the fact that the stock does not know you own it is one of the most important things about stocks. You feel a lot of different things about it. You remember how much you paid for it and who told you about it, but it does not care about any of that. It just sits there. If a stock's at $50, somebody paid $100 and feels terrible. Someone else has paid $10 and feels wonderful. All these feelings, it has no impact whatsoever. I bought something for $25 and now, 6 months later, it is worth only $20. This is not a good way to make money, so I am leaving this company. Too many investors make this mistake because they have forgotten why they are investing. Look at this as an example. 3 people put money into a company. One of them buys it for $10, another for $30, and the third for $50. Buffett tells the investors not to sell or buy stocks based on how they are doing right now. Instead, they should look at the stock's long-term performance and how the company is likely to do in the future. Number 3. Investing every day. It's often said that if you practice every day, you will get better.
If you feel you have to invest every day, you're going to make a lot of mistakes. It isn't that kind of a business. You have to wait till you get the fat pitch.
Most of the time, showing up every day means you are making progress. But if you have been paying attention, you may have noticed that many things in investing go against what you might expect. You might think it is a smart way to invest every day. But if you do, you are more likely to make mistakes that will cost you. Because investing is so complicated and time-consuming, it is not likely that you will find great businesses every day. It is hard to find real gems. So, if you trade every day, you might find smaller opportunities that make less money. Buffett has always thought it was important to keep your portfolio as small and well-rounded as possible. Imagine you only have a certain number of strikes when you're investing, so you do not miss out on the really good opportunities. If you only had a certain number of strikes, would you use them on things that do not add up? It is much better to buy a great company at a fair price than a good company at a great price, is one of Buffett's most well-known quotes. Number 4. Complicating investments. Buffett has always been a big fan of simplifying investments as much as possible. Even though it is easy for investors to put their money into businesses that are doing well, they should also know what businesses does, how it works, and what its core values are. In his 1996 annual letter to shareholders, Buffett said, "Intelligent investing is not complex, though that is far from saying that it is easy. What an investor needs is the ability to correctly evaluate selected businesses." Note the word selected. You do not have to know everything about every company or even most of them. You just need to be able to analyze companies that are in your area of expertise. Number 5. Over-diversifying. Diversifying your portfolio is a risk management strategy. To avoid putting all their eggs in one basket, investors choose stocks from different, mostly unrelated fields. It lets you try out different types of businesses and assets. Diversifying can be good, but if you do it too much, your portfolio could be at risk. Diversification is not a word that Buffett gets excited about when it comes to his investment strategy. He is the chairman of Berkshire Hathaway. Buffett said at Berkshire Hathaway's annual meeting that diversification is best for people who do not know much about investing. He also said that a single portfolio does not need to have a very long list of stocks, because there are not that many good stocks to begin with. Buffett tells investors to do their research and learn enough to pick a small number of stocks that will do well over time. If you do not know much about investing, you will need too many stocks in your portfolio. Number 6. Underestimating the stock market. When you know for sure that a stock will do well, your view of the market is often what keeps you from investing in it. When you think the market cannot do something, you often miss out on great chances. Mr. Buffett says, there have been many times when opportunities and things within his circle of competence have come up that he did not take advantage of. This is also connected to the point where we talk about being attached to the price. If you have a stock in your portfolio and do not buy more of it because it is now worth more than when you bought it, you are making a big mistake. Sometimes, making a mistake on a mission can be as simple as waiting forever for the price to go down. It does not happen very often for many valuable businesses. Munger said that he made a big mistake when he was first starting out as an investor and was offered more than 1,000 shares of Belridge Oil for very little money. He did not take the chance. That's why at the time, he decided not to go with the deal. Later, Belridge was sold for a huge profit, which would have made it easy for Munger's investment to grow by more than 300 times. Of course, he cannot know for sure what will work and what won't, but if you are good at something, Mr. Buffett says to go for it. Number 7. Overestimating the stock market. Aggressive growth predictions can sound good, but they almost never come true. Buffett says that only a very small number of businesses can reach the amazing growth they promise. Often, investors are influenced by the high price, the success of the business right now, and optimistic predictions. That Buffett says, expecting such exponential growth and investing based on that is a huge mistake. Now, this does not mean that you should stay away from companies that are expected to grow. Even Buffett likes to invest in growing companies, like some of the ones he bought recently. He especially likes to invest in growing companies that only need a small amount of capital. Companies with high prices will need more capital to grow and bring in real returns, a thought that does not fit with Buffett's way of investing. Be wary of high-priced businesses that are growing quickly and making a lot of noise. Can they last for a long time? Just give it a thought once. Number 8. Relying on market timing and predictions. Mr. Buffett argues, you are making a serious mistake if your portfolio is centered on market timing and projections. The market is too volatile to make your choices. Its unpredictability makes you a sitting duck if you follow timings and predictions. Pop culture, natural calamities, war, inflation, anything can affect this. For that, strong market sustainable stocks are needed to be invested in. Investing merely requires focusing on what matters. Sure, are war, inflation, and natural disasters predictable? Can you forecast the opening stock market price? Not exactly, but top companies will survive. Coca-Cola is one of the few corporations Buffett has praised for this. And with that, we've come to the end of the video. Don't forget to like and subscribe for more financial investment related content.